Oh man, who's ready? This is what we've all been waiting for. Okay, that sounded really loud and annoying, but it's true. This is what we've all been waiting for. We are 3 minutes away from the Federal Reserve decision on what to do. What this means is we are going to get two things. We're going to get a SEP, which is a summary of economic projections. We are, as soon as possible, going to try to jump over and figure out what the rate projections are going to be. Oops. But anyway, yeah, we're gonna quickly jump to see what the rate projections are going to be. We are going to get a statement quickly on what the pace of the taper is, and we're going to see what if there's any change to rates. We're not expecting a change to rates. We're expecting bond purchases to go down to 75. So that's the key thing we're expecting is 75. If he says 60, it means the taper pace accelerated. If he says 85, it means they didn't taper as much as they actually thought they would. So kind of exciting. We'll see what happens here. Kind of nervous. Stocks and crypto, worth noting, slightly rebounding right now. Now that's possibly because a lot of us have been buying the dip here. I've been sending quite a few alerts for buys here because I've been buying the dip on some of my faves. The S&P was down as much as 0.5%, and we've seen some stocks at some pretty substantial lows. Quite excited to see what happens in the next 2 minutes here. Now, yeah, okay, how are we going to do this? So keep in mind, I'm probably going to pull up CNBC because I believe they get the embargoed release. What that means is they already know what the answer is, but they just can't talk about it until 11. I don't have that kind of media privilege, so, but I will also be trying to pull up the documents myself so we can then go through them together. So we'll kind of double tag, see who has it first. We are now 60 seconds away. We've got the SPY up right here. People are buying this dip right now, which is a healthy sign. I mean, look at some of these low levels we've got here. Okay, 105 Affirm. Tesla's pretty low right now. Relative under the pressure of Elon's sales. BTC, Ethereum sitting right around those support levels. Still got Nvidia green, SoFi sitting under support levels. There's some nice opportunities. Hood is at all-time lows. You got 52, 53-week lows on things like Wayfair, PayPal, Square. Obviously the small caps, the recoveries are getting hit under Omicron. But really where the focus is going to be right now is going to be on the NASDAQ, on tech, on the SPY. Growth companies. Growth companies are what we're waiting for. Okay. Ooh, it's going to be fun. 20 seconds to go. So again, CNBC is probably going to beat me to it, but we'll see. We'll see. I'm searching now.
It sounds like the markets overall would be flat to higher potentially. I mean, as long as we don't get an extremely hawkish surprise.
Yeah, here we go.
Actually, you know what? We're going to get straight to. I'm sorry, we're going to get straight to Steve Leisman because we do have the Federal Reserve's decision on interest rates. Steve.
30 bill.
Federal
That's
Reserve
what we expected.
doubled the size of the taper to $30 billion a month. The Federal Reserve adjusted the tape, said that it will adjust the taper further if warranted. It did leave the funds rate unchanged at 0.
Good. Okay, as expected. Everything as expected right now. That's good.
By the economic outlook, it will maintain 0 rates until maximum employment is achieved. Now, the Fed is no longer using the word transitory, doesn't call inflation transitory. More on that in a second, but I want to show you what it looks for. The median Fed forecast now looks for a 0.9% funds rate in 2022. That's up quite a bit from where it was, and even more aggressive than we saw in our CNBC Fed survey, and for 1.6% for 2023. So call that what you want to call it, 3 or 4 hikes next year. 2 or 3 hikes.
Yep, the S&P is falling on this. So we're going to have some more opportunities here. Let's keep listening. A Federal Reserve website's not even loading right now.
Forecast, but it does see it coming down in 2022 to 2.6%. The Fed saying supply-demand imbalances are what are contributing to the elevated inflation level. It sees risks from the new variant to the economic outlook of the virus. The decision was unanimous. Job gains have been solid, it said. The unemployment rate has declined substantially. Now, importantly, and maybe somewhat amusingly, the Fed said it is no longer seeking inflation above 2%. So doubling the taper, but keeping it 0 and saying maintain it until maximum employment is achieved. Kelly?
Okay, so here we go. So what we have is expectation met. Expectation has been met. We're tapering 30 bill, and we're not raising rates. That's the expectation. Cannot even get the Federal Reserve website to load right now. I'm trying on like multiple different internet connections, and it is just not loading. But no worries, we already got the answer. Now, Federal Chairperson Jerome Powell, Federal Reserve Chairperson Jerome Powell, he speaks in 28 minutes. So we're going to get a lot more insights in 28 minutes. It does sound like, though, the expectations for rate increases were higher than expected, expecting to, it sounds like, have 3 rate increases to get us to 0.9% on sort of the average expectation by the end of 2022. That would mean we would have to raise rates once to 0.25 to 0.5, once to 0.5 to 0.75, and then once again to 0.75 to that's 3 rate increases expected now by the Federal Reserve survey in their dot plot. I'm going to try to get these things up here. Here is their actual statement. The Federal Reserve is committed to using a full range of support. We've heard all this stuff before. And really what we're looking for is this section right here. The committee seeks to achieve maximum employment, inflation rate of 2% over the long run. To support these goals, we decided to keep the target range for the Fed funds rate. This is that reiteration that rates are staying stable. And then, of course, the taper question is right here. What do they say about the future taper? Committee decided to reduce monthly pace of its net asset purchases by an additional 20 bill for Treasury securities and 10 bill additionally for agency-backed mortgage-backed securities. Okay, good. So there's your 30 bill. This is as expected. Now, it does look like we're having a little bit of pop here. Hold on a sec. Before I keep looking at some of this Fed stuff, having a little bit of pop here on the S&P. We're actually having a pop on Tesla as well. This is kind of what we expected. This is one of the reasons I probably just spent like $600,000 talking with course members about some stuff that I was buying just minutes before this release. The market is actually cheering that this is not a rug pull. It looks like Tesla's now going green on this news. And just because you see these minute candlesticks doesn't mean that it's going to last. But it is a sign that the market is starting to cheer this. Again, Jerome Powell could ruin this. So don't blow everything you have. Jerome Powell could ruin this when he's talking. But I'm going to go shopping right now myself a little bit more than I had just about because I said I would. I just went shopping about 15 minutes ago when things were nice and cheaper. And now I'm going to grab a little bit more because I said I would. And I like doing what I say I'm going to do. So I'm going to look at some of my faves here. So I'm picking up a little bit more. Again, if you're not part of the Stocks and Psychology of Money course, I don't know why you're not. You should really check that out because at the very least you get those alerts. Use that Xmas coupon code. But we literally just bought multiple of these stocks that are now moving up nicely here right before the Fed meeting. So we got a nice bigger discount here before the Fed meeting, but don't let that make you fearful because we are at relatively low prices here. So I do wish this would move a little faster. For those of you in the Stocks and Psychology of Money course, I'm going to quickly just say what I'm buying. Tesla. Okay. So I wish this would move a little faster, but I am going shopping a little bit more right now. Again, I intended to do this on a bounce, and it is possible. And I did most of my shopping before this bounce already, so I feel happy about that. But I'm going to grab a little bit more now. Okay. Okay. And it looks like you've also, you've got a multitude of bounces here right now. These are some low prices. I think you can really establish nice positions in still. This is not a rug pull by the Fed. This is literally what Jerome Powell told us we should expect. This is why, again, I did most of my purchasing beforehand. So I'm excited about this. Okay. I also said I would establish some position. Take a look at this one, folks. Here's another one. Hold on one sec. Okay. So yeah, Roku was another one, super, super low, fell like almost a high of 13% today. Looking at some other, it's also rebounding right now. Let's see BTC USD. Let's take a look at this. Oh yeah, there we go. There we go. What did I say this morning? This morning, I literally said, folks, it was going to be leading up to the meeting. We were going to go back to support and that we were likely to get a bounce after the meeting. That's literally what we're experiencing right now, which is awesome. Awesome, awesome, awesome. Another one that's probably super low right now. Let me see here. Hood. Yeah, you got to bounce on Hood as well. This morning, I also... I bought 420 YOLO call options on Hood, and let's just say I got a way better price than what it is right now. But this is good. Now, we have to be careful, okay? Don't blow all of your money. That's because Jerome Powell's still going to be speaking in 22 minutes. So even though I'm doing a little bit of shopping right now because I see some opportunities on this rebound, all of this rebounding could U-turn very, very quickly if Jerome Powell says the wrong thing. So I would not blow all of your money. But again, most of my purchases were done before this this release here. I am doing a little bit more purchasing right now. I mentioned I would do most of my purchasing before, which I've done over the last 3 days. And now I'm doing my the rest. Okay, cool. So now what we're also going to do is we're going to look at the summary of Federal Reserve economic projections in just a second. Okay, there we go. There we go. Let me get the summary of economic projections up really quick. See if the Fed site's actually loading now. Because that's, let's see, summary of economic projections are out. Good. Okay, this is going to be big. This is what we're going to look at here. PDF projections. Waiting for that PDF to load. Keep in mind, be patient on a U-turn. I did a little bit more shopping, but again, be patient because Jerome Powell can say something stupid and all of this could turn red again. But, don't be bashful if there are some companies that are at some juicy prices. See, you're getting a little bit of that U-turn. That's okay. Okay, so summary of economic projections by the FOMC, and this is dated 12/15. Okay, here we go. Let's now look at the SEP, and then I'm going to save some buying power as well for if we get larger pain in the future. I'm hoping this is potentially a beginning of a Santa Claus rally. Some people think I'm crazy for saying that. I think that this might be the potential future of a beginning of a Santa Claus rally, but I really think the market was starting to price in like worst case scenario where the taper's going to zero and rates are going to go up immediately. Here you go, folks. Wow, that is a big revision, though, in rates. I have to say, this is a big revision right here. Federal Reserve's September projection, the September projection was that we would, in 2022, have rates that would go up to 0.3 and an average of 1% in 2023. We're now expecting, this is almost triple. It is triple. This is triple right here. So expecting 3 rate increases now in 2023. Now, in fairness, this is what Wall Street expected. It is not it is not worse than expected. And I think that's why we're seeing a little bit of a bump in markets right now. Not huge. S&P did go positive. Let me see quickly. How did the other indices do? All indices just turned green. Okay, so all indices are green. We're expecting 3 rate increases. So we're going to write that here. That's 3 rate increases for 2022 and 2 rate increases in 2023 and 2 rate increases in 2022. This used to be, just for reference, this used to be 0, 2, 3. So look at how the Fed is U-turned here in that they're expecting to increase rates much sooner than expected. So that's important to keep an eye on. Okay, expectations for inflation. You ready for this? The PCE, just pretend that says CPI. They're very, very similar. Okay, very similar here. The PCE expectation is that by the end, by 2021, we are at the end of 2021. Well, obviously their expectation was way wrong for the end of 2021 since we're at, a core inflation rate that's much higher than this. But anyway, core let me go with PCE rather than core. That way we don't have to explain the difference here. This right here in CPI world is a 6.8%, right? So obviously way higher than even the Fed's projecting now. But look at this. They're expecting inflation to halve in 2022 and then to finally kind of slowly go down. So they're expecting inflation to go down half in 2022. If you believe them, then buy the dip. If you don't believe them, do not buy the dip. S&P is continuing to run up right now. So this is, again, we met expectations. The market did not get rug pulled, and the market is happy about this. Remember, folks, we talk about this all the time, not only on the channel. I mean, obviously, we talk about this in the Stocks and Psychology of Money course. Use that Xmas coupon code before the price goes up at the end of Christmas Day. But we talk about this all the time on the channel. When are the prices the best to buy? When uncertainty is at its highest point. Again, why did most of my buying before this? But look at, go back, look at the S&P 500, for example, back in front of the election. Remember when we were worried about having a contested election? And you go back to, what was it, October, look at that, October 2020, the dips we get over here in September and October 2020. I know right now those don't look very big, but then they were very painful, more painful than what we're experiencing now. Just worth remembering that when we think about investing. It's times of fear and uncertainty when people are leaving comments like, oh no, I'm going to quit investing in stocks. Oh no, I'm catching a falling knife. Bull crap. That's the time to buy. Okay, keep going back here. So GDP expectations, they are expecting slowing GDP. This is going to accelerate fears of stagflation, but it's worth noting that they actually think GDP is going to be a little slower in 2021 than initially expected. But look at this, be a little bit hotter than expected in 2022. Now that's counter to what a lot of people believe. A lot of people believe we're going to see much more slowing in 2022 in terms of GDP. So this is actually bullish by the Fed. They are suggesting that even though they are going to raise rates 3 times when previously we expected 0 rate increases for 2022, even though we're going to raise rates 3 times in 2022, they still think GDP is going to grow faster than expected and unemployment is going to go down more than expected, which is great. That's very, very good. I want to see the range. Okay, so this is the median expectation, but the range is also important, which is easier to see with the dot plot. But I want to look at the range of rates that we saw. So the range of rates we saw, 0.9 was actually the highest part of the expectations for rates. And some folks must have bet that rates would go up to 1.9%. So that was the range. Let's look at the dot plot, which is right here. Oh, this has moved so much. This is incredible. Oh my gosh. Okay, so we have every single member is in agreement that rates are going to go up in 2022. That's a big change. Now, again, Wall Street expected this, but that is a big change. Every single member believes rates are going to go up in 2022. So there's no doubt, given that they control it, there's no doubt that rates are going up in 2022. This is a unanimous signal that rates are going up at least once in 2022. Look at this. The consensus, folks, that 0.9 is right here. That's your median. You do not have a lot of people that think we're going to go more than 3 rate increases. But this right here, folks, this is 3 rate increases in 2022. And then they're guaranteeing you basically at least 1, but if not 2 rate increases here in 2023. They're really charting this course here, and then either that 1 to 2 rate increases here in 2024. But you now have a guaranteed liftoff happening in 2022 at some point. Keep this in mind. In fact, actually, let's pull up the calendar here. Federal Reserve meetings schedule, FOMC. So they make these announcements. Yeah, here we go. So in 2022, next year, 2022. Okay, look at this, folks. They need to raise rates 3 times in 2022 based on this dot plot. Look at their meeting schedule, folks. 1, 2, 3, 4, 5, 6, 7, 8. They only have 8 meetings. So that means 3 out of every 8 meetings next year, they are going to raise rates. 3 out of 8 for giggles. What is that, 40%? That's 38% of the meetings next year. We expect rates to go up. Now, Now let's take this one step further, okay? We're not going to raise rates in January unless we've fully tapered in January. We're not going to raise rates in March unless we've completed the taper by then. This is a question mark. I'm not sure if we're going to raise rates here. I can say almost with certainty that by May, as long as things stay the same, we're probably going to have our first rate increase in May. So I'm going to say May we'll have our first, and I think they'll be quick, honestly. Depending on where CPI is, we could potentially have June for the second, and then I'm going to give it a breather and go November for the third. So I'm going to write down this is Kevin's guess, which for those of you investing in stocks means you should be insulated from rate increases until May. So in other words, folks, cheap money is still coming. The party is still going till May. Now, it is worth noting that that's Kevin's guess, okay? Kevin's guess could be entirely wrong because take a look at this. I just got a notification here that Fed futures, Fed funds futures are indicating a 90% chance of first increase by April, which would mean that increase would happen in March. So that means March pause liftoff. So that's the potential. So between March and May, that's when we're going to get our first liftoff here. So, okay. Then let's see here. What else do we have? Hold on. Somebody's ranting about transitory. Okay, listen. The Fed did not change course on transitory. Let's make this like crystal clear. They stopped using the word because of political pressure by Joe Biden and the threat that Jerome Powell was going to lose his job. So they stopped using the word transitory. The Federal Reserve still thinks that high inflation is going to be transitory. How do I know that? Because they literally tell us right here. It literally says it right here. See? High inflation. Oops, that's definitely the wrong thing. There we go. High inflation right here of 5.3%. They expect to have in 2022. So no, the Federal Reserve did not change course and all of a sudden say, oh, that's it. It's no longer transitory. That's not what they're saying. They still think it's transitory. They're just not using it because it's bad politics. That's it. So just keep that in mind when you think about the Fed. Like people are trying to brand this as a U-turn, especially like the right-wing media. And you know me, I bash both media, okay? I sent a cease and desist letter to CNN. So I think you can't be more in the middle if you're bashing both sides. I bash everything. Let's see here. I bash myself too. Okay, let's see here. What else? Okay, these are just some more graphs reiterating some of the projections here. Forecast uncertainty. I mean, this is no big deal. Really, the big piece of this puzzle is this particular chart here. Central tendency. I'm sorry. I misread. So this is actually central tendency. The range, this is what I was looking for here. Sorry, this makes more sense. The range here. So there is somebody who does see rates of as high as of us breaking over 1% potentially in 2022 and breaking 2% in 2023. But you see that more visually depicted right here. So I want to just reiterate what we have here. Jerome Powell does speak in 10 minutes. I'm going to go back and look at the sticks here in just a moment. But let's just reiterate this really quick. We are expecting that in 3 out of the next 8 meetings of the Federal Reserve, because we're done. We're done for 2021. That means probably not January. I would say there's probably like a 5% chance of a liftoff in Jan. Okay. 5% chance of a liftoff in January. There's, according to the market, a 90% chance that we get liftoff in March, basically, which is what the market thinks. I think maybe May, but it's going to be either March or May. Probably I just need to align with March and just be okay with it. But anyway, they're guaranteeing us a rate increase in 2022. And it's likely going to be 3 rate increases in 2022, which means 38% of the meetings are going to have a rate increase, 1 to 2 rate increases in 2023, 1 to 2 rate increases in 2024. They do expect inflation to have in 2022. Not only do they expect inflation to have in 2022, but with the rate increases, they expect GDP to actually go up, which is wild. Okay, now take a look at this. S&P literally bouncing off of our trend line. That's wild. Love my trend lines. If you want to learn how I write my trend lines, join the Stocks and Psychology Money Group. Never heard that one before. We do have a little bit of a drawdown here on Bitcoin. Now, my guess, why would it make sense that we see a little bit of a SPY and Bitcoin drawdown? Because we met expectations, people bought the dip. Now we're standing by for, guess what? Powell talking in 8 minutes. Powell's talking in 8 minutes. Look at that. Trade desk went green. Nice. Little lumpiness over here. Let's go. Ooh, C3AI is up 8%. Tesla still vacillating here. So did run up to about 962. Again, I did my buying here, 933. I did buy a little bit right afterwards. So now we've got, where's ARK? ARK. Bloomberg just ran a piece about how most investors in ARK-K are about to be upside down with it around $90. It did bounce back to about $92. So a nice expectation bump here. Very good. Matterport under 22. It's another deal here. If we get a Santa Claus rally, it's going to be fun. Look at Robinhood, folks. Folks, you might hate Robinhood, okay? You could hate the crap out of Robinhood. I'm not telling you to buy and hodl this thing, but let me just put it this way. I put some YOLOs in on this thing, and I'm not trying to pump it. I don't care if I'm wrong. Don't listen to me. I'm just saying you had 75% of the shares of Robinhood released via a lockup in December. So you had a lot of shorting going into December, and then when people could start selling, it pushed it to the bottom along with the uncertainty here. I only see upside here, especially if they start releasing some more crypto updates. Anyway, my take. Okay, I've mentioned it. Done mentioning it now. Okay, Jerome Powell, 6 minutes to go for J Powell. Roku still sitting at 199 here. Roblox down 10%. And that 96 is not bad. Big Kathy Woodstock there. Look at Neo, folks. It's at 29.92. I mean, at some point, you're going to get to just overblown Chinese fears here. But then again, we thought that about Alibaba. I never bought it because I was too much of a baby to get into the Chinese stuff. But I remember when this thing was like under 200, I'm like, oh my gosh, Alibaba under 200. It's such a value stock. It's like, well, then you got China. And then it's almost half that, which is just insane. That defies logic. But logic doesn't apply when you have, a government that doesn't operate with necessarily. I don't want to say doesn't operate with logic. Their own logic. They're doing what they think is best. You can't blame them for that. Cloudflare. Why? If you have not watched my video on the Log4j hack, watch Cloudflare. Watch that video. You will understand why I've got 7 figures in Cloudflare. It is pricey though. DocuSign bouncing here. Nvidia. Ooh, nice bounce there on Nvidia. That's like a 2 or 3% bounce there. Yeah, also pulling down a little. Wait, hold on. We're not on the miniature. There we go. Pulling down a little bit. Okay, breathe, Kevin. I know. I need more coffee. I need more coffee. Gotta love those diamond hands. These are the kind of days you wait for. It's delicious. I love these days. I love fear and uncertainty. I love it so much. I hate it when stocks are skyrocketing. I hate it. That's when people call me Mr. FUD. They're like, man, stop trying to take away the punch bowl, man. Okay, so Jerome Powell speaks in 4 minutes. If you're just now joining, I'm going to give you a very, very quick summary. Okay, so quick summary. Okay, because Jerome Powell speaks in 4 minutes. This is going to be big because J Powell could literally crash everything. Like, we could think we got a good deal this morning. J Powell could destroy everything. All right. So here's a quick summary as to what the Federal Reserve just said. The Federal Reserve is essentially guaranteeing us 3 rate increases for 2022. I mean, they're guaranteeing us a rate increase for 2022, but they're pretty much saying, yeah, we're going to raise rate 3 times. Now, they only have 8 meetings in 2022, which means they are going to raise rates likely 3 out of 8 meetings, unless in one of the meetings they raise rates essentially double-fold, which I don't think they will do. That would be a little too much for the market to handle. That means 38% of the meetings next year, the Federal Reserve is expected to raise rates. We then expect rates to go up 1 to 2 times in 2023 and 1 to 2 times in 2024. Now, the Federal Reserve Fed funds futures are expecting that we will have our first rate increase by April. The only meeting That's not January at the beginning of the year, which the taper's not going to be done by January. We don't expect. We expect the taper to be done in March. So that would mean the market is expecting interest rates to go up for the first time with a 90% chance of certainty, according to the market, in March. Personally, I think May, but the market might end up being right with this. That's a pretty high level of certainty. Now, despite these 3 rate increases, the Federal Reserve has increased their GDP projection from 3.8% to 4% for 2022. And they expect that the unemployment rate will fall faster than they previously expected in September. When they thought the unemployment rate would go down to 3.8% in 2022, they think it's going to go down to 3.5%. Now, a lot of folks complaining that the Federal Reserve is U-turning on their transitory claim. Not exactly true. The Federal Reserve believes that inflation is going to fall from what they believe is an end-of-the-year 5.3% level of inflation via PCE, which we don't have yet, all the way down to 2.6% in 2022. Now, obviously, they're low on the numbers so far for 2021, but either way, they're expecting a halving in 2022. So this gives you a sort of a summary of what the Federal Reserve just said. Keep in mind, they are tapering, they're accelerating the taper as expected, and they're announcing these rate increases as expected. Now, Jerome Powell is going to start speaking in 2 minutes. So we're probably going to see a little bit more pain in the market because of J-Pow, because people get nervous about what he's going to say. In fact, you could see just that. Look at that. The S&P 500 hit our trend line and has literally U-turned here. So you're going to get another bite at the apple to nibble. Keep in mind, whether you did what we did in the course member live stream or earlier today, and you went shopping for Tesla in the low 930s, or you went shopping for Tesla at 960, or you're going for shopping for Tesla now at 940. None of this matters. Like this is minor, okay? The difference of $30 on 930, just to make it very clear, or 950-ish an average here, is roughly about 2.5 to 3%. Call it 3%. It's not that big of a deal. We want to invest in the long term for big moves. I mean, we're talking doubles here, right? We want, and my price target for 2025 for Tesla is $17.50, which means we're almost at a double, which works out to a compounded annual growth rate of 15%. Double between now and 2025 would be about 15%, which is great. That's what we're investing in for the longer term. So in my opinion, all of these fluctuations here in price, juicy. I want to increase my positions in these. That's why I'm buying. That's why I bought before. That's why I bought a little bit after. And now I've got some more saved up just in case Jerome Powell decides to go ape on the market, or maybe I shouldn't say ape, decides to go ham on the market and say some crazy stuff. Anyway, let's also look at crypto prices here. BTC USD. We are sitting at, look at that fall. Look at that. You got expectations met. People buy the dip because we are at relatively decent prices. But wait. Oh no. J-Pow's going to talk in like 10 seconds. Oh no. Prices start falling. So we're going to jump on over to J-Pow's speech in just a moment. First, he's going to give us a speech, and then we're going to listen to the Q&A. I expect the most important portion is going to be the Q&A, not necessarily the actual speech. So we'll see. But we are waiting for the Federal Reserve to begin their broadcast. I have, okay, here we go. Are we going to their broadcast?
We're strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, in support of these goals, the Federal Open Market Committee kept interest rates near zero and updated its assessment of the progress that the economy has made toward the criteria specified in the committee's forward guidance for interest rates. In addition, in light of the strengthening labor market and elevated inflation pressures, we decided to speed up the reductions in our asset purchases. As I will explain, economic developments and changes in the outlook warrant this evolution of monetary policy, which will continue to provide appropriate support for the economy. Economic activity is on track to expand at a robust pace this year, reflecting progress on vaccinations and the reopening of the economy. Aggregate demand remains very strong, buoyed by fiscal and monetary policy support and the healthy financial positions of households and businesses. The rise in COVID cases in recent weeks, along with the emergence of the Omicron variant, pose risks to the outlook. Notwithstanding the effects of the virus and supply constraints, FOMC participants continue to foresee rapid growth. As shown in our summary of economic projections, the median projection for real GDP growth stands at 5.5% this year and 4% next year. Amid improving labor market conditions and very strong demand for workers, the economy has been making rapid progress toward maximum employment. Job gains have been solid in recent months, averaging 378,000 per month over the last 3 months. The unemployment rate has declined substantially, falling 0.6 of a percentage point since our last meeting and reaching 4.2% in November. The recent improvements in labor market conditions have narrowed the differences in employment across groups, especially for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor force participation showed a welcome rise in November, but remains subdued, in part reflecting the aging of the population and retirements. In addition, some who otherwise would be seeking work report that they are out of the labor force because of factors related to the pandemic, including caregiving needs and ongoing concerns about the virus. At the same time, employers are having difficulties filling job openings, and wages are rising at their fastest pace in many years. How long the labor shortages will persist is unclear, particularly if additional waves of the virus occur. Looking ahead, FOMC participants project the labor market to continue to improve, with the median projection for the unemployment rate declining to 3.5% by the end of the year. Compared with the projections made in September, participants have revised their unemployment rate projections noticeably lower for this year and next.
Bullish.
Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. In particular, bottlenecks and supply constraints are limiting how quickly production can respond to higher demand in the near term. These problems have been larger and longer lasting than anticipated, exacerbated by waves of the virus. As a result, overall inflation is running well above our 2% longer run goal and will likely continue to do so well into next year.
Ooh.
While the drivers of higher inflation have been predominantly connected to the dislocations caused by the pandemic, price increases have now spread to a broader range of goods and services. Wages have also risen briskly, but thus far, wage growth has not been a major contributor to the elevated levels of inflation.
That's good.
We are attentive to the risks that persistent
Not for employees, but
in excess of productivity could put to upward pressure on inflation. Like most forecasters, we continue to expect inflation to decline to levels closer to our 2% longer run goal by the end of next year. The median inflation projection of FOMC participants falls from 5.3% this year to 2.6% next year. This trajectory is notably higher than projected in September. We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are committed to our price stability goal. We will use our tools both to support the economy and a strong labor market and to prevent higher inflation from becoming entrenched. We will be watching carefully to see whether the economy is evolving in line with expectations. The Fed's monetary policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee reaffirmed the 0 to 1/4% target range for the federal funds rate. We also updated our assessment of the progress the economy has made toward the criteria specified in our forward guidance for the federal funds rate. With inflation having exceeded 2% for some time, the committee expects it will be appropriate to maintain this target range until labor market conditions have reached levels consistent with the committee's assessments of maximum employment. All FOMC participants forecast that this remaining test will be met next year. The median projection for the appropriate level of the federal funds rate is 0.9% at the end of 2022, about a half percentage point higher than projected in September. Participants expect a gradual pace of policy firming, with the level of the federal funds rate generally near estimates of its longer run level by the end of 2024. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. At today's meeting, the committee also decided to double the pace of reductions in its asset purchases.
As expected, and SPY is green again.
We will reduce the monthly pace of our net asset purchases by $20 billion for Treasury securities and $10 billion for agency mortgage-backed securities. If the economy evolves broadly as expected, similar reductions in the pace of net asset purchases will likely be appropriate each month, implying that increases in our securities holdings would cease by mid-March, a few months sooner than we anticipated in early November. We are phasing out our purchases more rapidly because with elevated inflation pressures and a rapidly strengthening labor market, the economy no longer needs increasing amounts of policy support. In addition, a quicker conclusion of our asset purchases will better position policy to address the full range of plausible economic outcomes. We remain prepared to adjust the pace of purchases if warranted by changes in the economic outlook. And even after our balance sheet stops expanding, our holdings of securities will continue to foster accommodative financial conditions. To conclude, we understand that our actions affect communities, families,
Q&A comes now.
Across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to complete the recovery and employment and achieve our price stability goal. Thank you. I look forward to your questions.
All right. This is the important part. This is the part that could derail everything.
Go to Rachel from the Washington Post.
Thank you very much, Michelle, and thank you, Chair Powell, for taking our questions. The latest FOMC materials say that the FOMC thinks it will be appropriate to keep rates near zero until labor market conditions reach levels consistent with maximum employment. And there are also 3 rate hikes penciled in the projections for next year. In order to set up those hikes, what will maximum employment have to look like? When will you know that that threshold has been met? And how will that be communicated? Thank you.
So maximum employment, if you look at our statement of longer run goals and monetary policy strategy, maximum employment is something that we look at a broad range of indicators. And those would include, of course, things like the unemployment rate, the labor force participation rate, job openings, wages, flows in and out of the labor force and various parts of the labor force. We'd also tend to look broadly and inclusively at different demographic groups and not just at the headline and aggregate numbers. So that's a judgment for the committee to make. The committee will make a judgment that we've achieved labor market conditions consistent with maximum employment. When it makes that, it is admittedly a judgment call because it's a range of factors, unlike inflation.
Okay, so far, nothing surprising in the statement. Everything along expectations. SPY heading back up. I still think that there are some beautiful buy the dip opportunities. We're going to keep listening here in just a moment. I'm personally staying away from recoveries, waiting for bigger U-turns on small caps, focused more on tech companies that are selling off, whether that's Snap, Matterport, Roku, Tesla, Enphase, Square, you name it. Let's keep listening.
Thank you, Mr. Chairman. My question is, if it's often said that monetary policy has long and variable lags, how does continuing to buy assets now, even though it's at a slower pace, address the current inflation problem?
Good question. Why are you still printing money if you've got all these inflation expectations and you got to raise rates 3 times? Why don't you just stop now is really what this question is. And use that Xmas coupon code down below for my programs on building wealth.
The long and variable lag after you end purchases sometime in March that you'll start to have any impact on the inflation problem.
So on the first part of your question, which is why not stop purchasing now, I would just say this. We've learned that we're in dealing with balance sheet issues. We've learned that it's best to take a careful sort of methodical approach to make adjustments.
That's bullish.
Markets can be sensitive to it. And we thought that this was a doubling of the speed. We're basically 2 meetings away now from finishing the taper, and we thought that was the appropriate way to go.
That's right.
So we announced it, and that's what will happen. The question of long and variable lags is an interesting one. That's Milton Friedman's famous statement, and I do think that in this world where the global financial markets are connected together, financial conditions can change very quickly. And my own sense is that they get into financial conditions affect the economy fairly rapidly. longer than the traditional thought of, a year or 18 months, shorter than that, rather. But in addition, when we communicate about what we're going to do, the markets move immediately to that. So financial conditions are changing to reflect, the forecast that we made, and basically, which was, I think, fairly in line with what markets were expecting.
Yep,
but
that's why we're up.
Financial conditions don't wait to change until things actually happen. They change on the expectation of things happening. So I don't think it's a question of having to wait.
It's a really good question. He's basically saying, hey, look, don't worry about the 18-month thing. Markets are going to price in what we're doing right away. And yeah, Kevin here says buy real estate in January. Makes sense before rates go up.
Not raise rates until the taper is complete. Thank you.
Yes, he's going to say yes.
Yes, the sense of that, of course, being that buying assets is adding accommodation and raising rates is removing accommodation. Since we're 2 meetings away from completing the taper, assuming things go as expected.
I read this guy like a book.
Then you would stop the taper potentially sooner, but it's not something I expect to happen. But I do not think it would be appropriate, and we don't find ourselves in a situation where we might have to raise rates while we're still purchasing assets.
Okay, let's go to Colby at the FT.
Thank you, Michelle. Chair Powell, I'm curious exactly how much distance you think there should be between the end of the taper and the first interest rate increase. Back in 2014, the guidance that was given was for the Fed funds rate to remain at the target level for a considerable time after the end of the asset purchase program. Is that an approach you support?
She's basically saying, are you going to raise rates in March or May? That's what she's asking. It's a good question.
So we haven't made any decision of that nature. And so, no, I wouldn't say that's our position at all. We really haven't taken a position on that. I will say that we did talk today. We had our first discussion about the balance sheet, for example, and we went through the sequence of events regarding the runoff and that sort of thing with the balance sheet last time. And I think people thought that was an interesting discussion. They thought that it was informative, but people pointed out that this is a significantly different economic situation that we have at the current time, and that the differences that we see now would tend to influence how we think about the balance sheet. And the same thing would be true about raising rates. I don't foresee that there would be that kind of very extended wait at this time. The economy is so much stronger. I was here at the Fed when we lifted off the last time, and the economy is so much stronger now. It's so much closer to full employment. Inflation is running well above target, and growth is well above potential. There wouldn't be the need for that kind of long delay. Having said that, we'll make this decision in coming meetings, and it's not a decision that the committee has really focused on yet.
He's basically saying March. The market did not like that.
Let's go to Nick at the Wall Street Journal.
Little drop here. No delay, so not May, saying March.
Thank you. Nick Timoros at the Wall Street Journal. Chair Powell, in March, you answered a question about maximum employment like this. You said 4% would be a nice unemployment rate to get to, but it'll take more than that to get to maximum employment. More recently, you have hinted at a possible distinction between the level of maximum employment that's achievable in the short run versus in the long run. Has your view of the level of maximum employment changed this year? And if so, how? And how close is the economy right now to your judgment of the short run level of maximum employment? Thank you.
Right. So the thing is, we're not going back to the same economy we had in February of 2020. And I think early on, the sense was that's where we were headed. The post-pandemic labor market and the economy in general will be different. And the maximum level of employment that's consistent with price stability evolves over time within a business cycle and over a longer period, in part reflecting evolution of the factors that affect labor supply, including those related to the pandemic. So I would say, look, we're at 4.2% now, and the unemployment rate has been dropping very quickly. So we're already in the vicinity of 4%. The way in which the important metric that has been disappointing really has been labor force participation, of course, where we had widely thought, I had certainly thought that last fall, as unemployment insurance ran off, as vaccinations increased, as schools reopened, that we would see a significant surge, if you will, or at least a surge in labor force participation. So we've begun to see some improvement. We certainly welcome the 0.2 improvement that we got in the November report. But I do think that it feels likely now that the return to higher participation is going to take longer. And in fact, that's been the pattern in past cycles, that labor force participation has tended to recover in the wake of a strong recovery in unemployment, which is what we're getting right now. So it could well have been that this cycle was different because of the short nature of it and the very strong, the number of job openings, for example. You would have thought that would have pulled people back in, but really it's the pandemic, it's a range of factors, but the reality is we don't have a strong labor force participation recovery yet, and we may not have it for some time. At the same time, we have to make policy now, and inflation is well above target. So this is something we need to take into account.
If I could follow up, you've talked recently about risk management, and so does that mean that the committee might feel compelled to raise interest rates before you're convinced that you've achieved the employment test in your forward guidance?
So this is not at all a decision that the committee has made, but you're really asking a question about how our framework works. And yes, there's a provision, what used to be called the balanced approach provision, that says in effect that in situations in which the pursuit of the maximum employment goal and the price stability goal are not complementary, we have to take account of the distance from the goal and the speed at which we're approaching it. And
okay,
so,
just really quick translation. He's basically saying, look, labor force participation, while it keeps getting referenced in the media, it's not as important of a big deal right now because we went through a pandemic, kind of a unique recession, quickly down, quickly up. Yeah, we're not recovering as quickly as we thought we would on labor force participation, but don't worry about it right now. We got to focus on inflation, and the unemployment rate is going down, which is good. So don't worry so much about labor force participation. Not something he's really worried about.
my thinking, in my opinion, and I don't at all know that we will that we'll have to invoke that paragraph. But just as a factual matter, that is part of our framework and has been really for a very long time.
Thank you.
Thanks. We'll go to Howard at Reuters.
And just so you know, I've got the S&P 500 above my head when you see this.
So I guess I got to ask about the elephant in the room, which is the Omicron variant. This seems to already be pushing one of your colleagues, the Bank of England, off its course. Things have evolved very fast there. Hasn't quite hit the shores of the U.S. in full force yet, but people seem to expect it to. So I'm wondering, in your feelings about this, are you convinced that this is going to be perhaps a more infectious but less serious variant of the virus, or are you simply confident that the U.S. economy can continue its divorce from the pandemic? Well,
I think there's a lot of uncertainty, which is why we called it out in our statement, our post-meeting statement, as a risk. We follow the same experts, and we talk privately to the same experts that everyone else does, and read the same articles in the paper and the same research. And so you mentioned the early assessment is highly transmissible, perhaps not as severe, some continuing protection from existing vaccines and also existing immunity from having had the disease. That's a first draft. We're a long way from knowing what it will turn out to be. It may well come to the United States and replace Delta as the dominant variant fairly quickly. That could easily happen. I think there's another step there, though, which is what's going to be the effect on the economy, and that will depend, on how much it suppresses demand as opposed to suppressing supply. It is not clear how big the effects would be on either inflation or growth or hiring. On top of what's already going on, which is quite a strong, wave of Delta that's hitting large parts of the country across the northern United States and all the way to the eastern seaboard, and now coming down. We're having quite a wave of Delta. So coming in on top of that, again, it's very difficult to say what the economic effects would be. I do think wave upon wave, people are learning to live with this. more and more people are getting vaccinated. So people who get the new variant, it affects them much less than it tends to affect in the aggregate people who are not vaccinated. So the more people get vaccinated, the less the economic effect. It doesn't mean it won't have an economic effect. Delta had an effect of slowing down hiring, and it actually it had an effect on global supply chains, and that sort of that hurt the process of the global supply chains getting worked out. So it can have an economic effect. I just think at this point we don't know much. We'll know a whole lot more in 3 weeks, and we'll know more than that in 6 weeks.
In my opinion, he's basically saying, look, Delta was bad for inflation. Delta was bad for unemployment. Delta probably led to more inflation now. We just don't know about Omicron yet, but he made it very clear that people are, quote, learning to live with this. And he's basically signaling he doesn't think Omicron is a big deal right now.
The economy and the strength of demand, the strength of just overall demand, the strength of demand for labor. Look at inflation, look at wages. I think moving forward the end of our taper by a few months is really an appropriate thing to do. And I think really Omicron doesn't really have much to do with that.
Thank you.
Let's go to Gina at the New York Times.
It'd be bad if he was freaking out about Omicron, right?
Hey, Chair Powell. Thanks for taking our questions. I wonder if you could talk a little bit about what prompted your recent pivot toward greater wariness around inflation.
Ooh, pivot.
Sure.
She's asking about the U-turn.
So I guess I would go back and, it's been a continual process, really. Inflation really popped up right in the late spring last year. And we had a view, it was very, very widely held in the forecasting community that this would be temporary. It was quite narrow. A limited number of factors were causing it. And there was a decent amount of evidence to support that view that it would be temporary or transitory, as we said. Certainly, we had 5 months of declining month-on-month, monthly readings of inflation, but we didn't see much in the way of progress on labor supply or on other supply side issues. Then in September, I'd say after Labor Day, we started to see, it started to become clear that this was both larger in its effect on inflation and more persistent. And of course, I said so on many occasions. And one of the consequences of that is that we moved the taper forward. We moved the taper forward, and it's a much faster taper than had been planned. So we've been adapting. I've been saying we're adapting our policy. So come to your real question. We got the ECI reading on the eve of the November meeting. It was the Friday before the November meeting, and it was very high, 5.7% reading for the employment compensation index for the third quarter, not annualized, for the third quarter, just before the meeting. And I thought for a second there whether we should increase our taper. Decided to go ahead with what we had socialized. Then right after that, we got the next Friday after the meeting, 2 days after the meeting, we got a very strong employment report and revisions to prior readings and no increase in labor supply. And the Friday after that, we got the CPI, which was a very high reading. And I honestly, at that point, really decided that I thought we needed to look at speeding up the taper, and we went to work on that. So that's really what happened. It was essentially higher inflation and faster, turns out much faster progress in the labor market. Really what's happening is the unemployment rate is catching up, seems to be catching up with a lot of the other readings of a tight labor market, 0.6 over one cycle. So that's really what happened. And, widely supported in the committee today, as you can see, unanimous vote. But beyond that, I think widely supported this move.
If I could just follow up quickly, you noted that the ECI was one of the things that made you nervous, but you also said earlier that you don't see signs that wages are actually factoring into inflation yet. And I guess I wonder how you think about sort of the wage picture as you're making these assessments.
Right. So what I said, you quoted me correctly. It's so far we don't see wages are not a big part of the high inflation story that we're seeing. As you look forward, let's assume that the goods economy does sort itself out and supply chains get working again, and maybe there's a rebalancing back to services and all that kinds of thing. But what that leaves behind is the other things that can lead to persistent inflation. In particular, we don't see this yet, but if you had something where real wages were persistently above productivity growth, that puts upward pressure on firms, and they raise prices. It would take something that was persistent and material for that to happen, and we don't see that yet. But with the kind of hot labor market readings, wages we're seeing, it's something that we're watching. And the other thing, of course, is rents, which are very important. Owner's equivalent rent and rent. That's another thing which is very economically sensitive. Unlike the things that are causing the inflation now, this is economically sensitive, and so would be expected to move up. And so as some things go down, the question is, where will we be when we come out the other side of this? And we need to keep our eyes on those things.
Thank you.
Thanks. We'll go to Chris.
Okay, so really quick, they're expecting inflation to half in 2022, but rents and wages could push that up. They don't see a sign of wages persistently pushing that up right now, but that could be a big thing that keeps inflation up longer than expected, even longer than expected.
Particularly if the Omicron variant does spread more widely. Would you delay rate hikes in that situation? And how would you think about that? And also, how would you explain rate hikes if you do follow through in that kind of situation with inflation fading and growth slowing? How would you explain rate hikes to the public, particularly those who may still be looking for work?
Well, as you know, the SEP is not a plan. It's not something we debate, negotiate over, or really discuss in terms of what the right answer should be. People write down their assumptions, their assessment of appropriate policy based on their economic forecast. And so the median, what you're talking about, the 3 rate increases, that's the median of the committee. The median of the committee is also that growth will be 4% and that unemployment will be 3.5% by the end of the year. So that's a really strong economy. And of course, if the economy turns out to be quite different from that, then so will the rate. No one will say, oh, we can't change our policy because we wrote something down in December. That no one's ever said that or will. It will. The actual rate decisions we make will depend on our evolving assessment of the forecast. So, for example, if the economy were to slow down significantly, then you would expect that would have an effect of slowing down rate increases. But we'd have to, we look at our 2 goals, maximum employment and price stability, and we make policy based on them, and not with respect to what we wrote down in a prior SEP.
Thank you. Let's go to Victoria Guida at Politico.
Hi, Chair Powell. I wanted to follow up on maximum employment. So, the new framework was basically designed, as I understand it, so that
recovery stocks are falling a little bit, by the way. I'm trying to find out particularly why. He didn't really say anything terrible about Omicron. It was more about Delta. So probably the Delta fears that are leading to a recovery sell-off right now.
I'm wondering, you've talked a lot about the different ways that you might measure maximum employment, but from what I understand, and that's still basically the way that you know that you're there, is inflation. So is that understanding correct? And are those signals likely to be clear right now, given that you have inflation that's caused by these supply chain disruptions that might also lead to inflation in wages and those sorts of things? So how do you sort of tease out the signal of maximum employment? Okay,
so let me start by saying that the inflation that we got was not at all the inflation we were looking for or talking about in the framework. It really was a completely different thing. It was to do with strong monetary policy and fiscal stimulus into an economy that was recovering rapidly and in which there were these supply side barriers, which effectively led to, in certain parts of the economy, of what you might call a vertical supply curve. So, automobile purchases are very interest rate sensitive, and you would think demand would drive up the quantity of cars, but it can't because they don't have semiconductors. So that was a very different kind of inflation. This is not the inflation we were looking for under our framework at all. It's nothing to do with our framework, and the way we've approached it is really nothing to do with our framework. But come to maximum employment, which is really your question. How do you know? So I think you look at prices and quantities. If you want to look at maximum employment, you look at prices and quantities, and the main price you look at is wages. It's one of the things you look at, and it's so I mentioned a number of the things. You could get to 20 if you wanted to easily, but labor force participation, the unemployment rate, different age groups of, prime age labor force participation in particular gets a lot of focus. The JOLTS data get a lot of focus. And wages, that's really one of the great signals. The quits rate is another one. The quits rate is really one of the very best indicators, according to a lot of labor economists, because people quit because they feel like they can get a better job. And there's, record amounts, historically high levels of that going on, suggesting, again, that you've got a very tight labor market. So on wages, that's the price indicator we look at to tell us, along with all the other data, whether we have labor market conditions that are consistent with maximum employment. And so that's how we think about it. But the one of the complications is that, again, we've got to make policy in real time. So how do we think about that? If we think we can make labor, participation might move up. Let's say we knew that it would start to move up in 2 years, would we wait 2 years or when inflation is running way above target? Probably not. So you have to make an assessment that what is the level of maximum employment that is consistent with price stability in real time is one way to think about it.
Just to kind of follow up on that for a second, if you do raise interest rates next year and you're not certain whether you're at maximum employment, I mean, are you all going to point, when you raise interest rates, are you going to point to ways in which the labor market could still improve?
Yes, I mean, I absolutely. I think, well, whether or not we say we're at conditions, labor market conditions consistent with maximum employment next year, we would all be open and I think expect over time that the level of maximum employment that's consistent with price stability would increase further over time. For example, through increasing participation. So we would certainly, we would not in any way want to foreclose the idea that the labor market can get even better. But again, with inflation as high as it is, we have to make policy in real time. We've got to make that assessment in real time.
Thank you. We'll go to Olivia from Bloomberg.
It was a good one.
Thank you. Good afternoon, Chair Powell, and thank you for taking our questions. I wanted to follow up on some of your earlier comments about labor force participation. And I wondered, what do you think needs to change in the economy to kind of get a meaningful recovery in labor force participation? And also whether running the economy hot, like in the last expansion, is one way of doing that.
Well, the labor market is by so many measures hotter than it ever ran in the last expansion. If you think about it, the ratio of job openings, for example, to vacancies is at all-time highs. Quits, the wages, all those things are even hotter. But what would it take for labor force participation to move up more? That really, why is it low is the question. So there are a bunch of answers, and all of them probably have some validity. Part of it will be that people, for certain people, they don't want to go back in the labor force because either they're medically vulnerable or they're not comfortable going back while COVID is still everywhere. That's one thing. The lack of availability of childcare made for caretakers is certainly part of it, not just for children, but for older people. It has been pointed out by many that the stock market is high, people's portfolios are stronger. They may go back to being a one income rather than a two income family. The same thing with people's houses. People they have a mortgage and with leverage and the house price increases, the equity they have in their home might have doubled and they might reach the same conclusion. So and people have savings on their balance sheet because of forced savings, because they couldn't spend on travel and things like that, and also because of government transfers. So for all of those reasons, and it's hard to know exactly the part each of them plays, we have a situation where we've had a shock to labor force participation that is not unwinding as quickly as many has expected, and people, in effect, a good part of it is voluntary. People, and this is how they want to maximize their welfare, and that's certainly their choice. In other cases, it's something that will abate very quickly if and when the pandemic gets under control. And the longer the pandemic goes on, maybe the less likely that people will come back because they get used to their new life and they lose contact with their old jobs. That's what the evidence would say. So it's a range of things. It isn't that the economy lacks stimulus. Usually in every other expansion, it's that there aren't enough jobs and people can't find jobs, and we're stimulating demand and trying to get demand to come up. That's not the problem here. The problem is a supply side problem, which what it would take to work it out, I think it's going to be time. And the number one thing it would really be to have the pandemic get under control. That's what everyone would really like to see. What does the labor force, what does the labor market look like in a world without COVID? That would be the thing that we'd really.
Just a quick note while he's talking about labor force participation getting better once the pandemic's over. I just want to mention that you've got quite a few movers at the moment. You've got Robinhood moving up more. You've got Cloudflare, cybersecurity firm, moving up here. Look at that. Affirm, buy now, pay later, moving very well right now. Ethereum back over 4,000. Nvidia up 4.5%. Still got a little bit of pain over here left over at Roku after that price downgrade. A little bit of pain over at Snapchat left. Big advertising plays for next year. Matterport moving up right now. Recovery stocks like Carnival Cruise Line's not doing great because of that Delta surge. Robinhood back over 19. And we'll keep an eye on some of these things moving. But definitely some things very excited about expectations here.
Participation would move down.
And he's still talking about labor force participation.
We can get back up closer to where we were in February of 2020, and indeed for the year or so before that, is a good one. And I mean, what we can do is try to create the conditions. There's a lot of good for society when you have a tight but stable labor market where people are coming in, they're getting in the labor force, they're getting paid well. In the labor market we had before, we had the biggest wage increases were going to people at the bottom end of the wage spectrum for the last couple of years. There were just a lot of really desirable aspects of a labor market like that. Higher participation is one of them, and we'd love to get back there. But again, ultimately, we have the tools that we have, which are essentially to stimulate demand and also to control inflation. I mean, really, it might be one of the two big threats to getting back to maximum employment is actually high inflation, because to get back to where we were, the evidence grows that it's going to take some time. And what we need is another long expansion like the ones we've been having over the last 40 years. We've had, I think, 3 of the 4 longest in our recorded history, including the last one, which was the longest in our recorded history. That's what it would really take to get back to the kind of labor market we'd like to see. And to have that happen, we need to make sure that we maintain price stability.
Okay, let's go to Edward Lawrence at Fox.
Thanks, Michelle, and thanks for taking the question, Chair Powell. So I was looking at the census data there for estimate monthly changes on sales, and what you're seeing is fewer people spending at restaurants and drinking places, more people spending at grocery stores. You see electronic sales down 4.6% month over month. Also, department store sales down 5.4% month over month. How concerned, or what is your level of concern the consumer may be turning away from this economy or pulling back because of inflation, the virus, or something else? Thank you.
We see consumer expenses very strong in this quarter. I don't know, Edward, whether you're talking about more shopping online versus shopping in the store, but consumer demand is very strong. Incomes are very strong, because people are going back to work and they're getting wage increases. Admittedly, some of the wage increases is being eaten away by inflation, but nonetheless, incomes overall are going up really significantly because of increased employment, and spending has been strong. There may be something in the seasonality that this year's holiday spending may have been pulled forward, and of course there may be effects from Delta, and there might be going forward from Omicron. But fundamentally, though, the consumer is really healthy, and we expect personal consumption expenditures to be pretty strong in the fourth quarter.
Okay, let's go to Mike at Bloomberg.
Mr. Chairman, the median forecast for inflation in this month's or this meeting's economic projections has been revised up significantly for 2021, but barely moved for 2022 and 2023. You've said you expect inflation to fall significantly. Is that because you're going to raise interest rates, or because the virus is going to fade and the effects are going to fade? In other words, is it a question of when, not if you raise interest rates? And does it suggest that maybe your critics are correct and you might be afraid you're behind the curve?
So actually, I'm looking at the SEP here, and the median forecasts for core and headline inflation did move up by 0.4 each. So that's a significant, in an SEP, that's a pretty significant move up. It's based on both of those things, I suppose. I do think there's a broad expectation among forecasters, including our own, that the bottlenecks will alleviate sometime over the course of this year. If you look at where blue chip forecasts are, which is the group of well-resourced large forecasting operations with a long track record, they'll show inflation coming back down significantly toward the back end of next year. I would say, though, as well, that our policy should begin to have an effect. There will be a lag, but it should begin to have an effect on that as well. That's the most likely case. I guess what the thing I would want to say, though, is we can't act as though that's a certainty, and we're not going to act as though that's a certainty. There's a real risk now, I believe, that inflation may be more persistent, and that may be putting inflation expectations under pressure, and that the risk of higher inflation becoming entrenched has increased. It's certainly increased. I don't think it's high at this moment, but I think it's increased. And I think that's part of the reason behind our move today, is to put ourselves in a position to be able to deal with that risk. And I think we are in a position to deal with that risk. We need to see more data. We need to see how the inflation data and all the data evolve in coming months. But we are prepared to use our tools to.
This is literally the perfect thing he could say. He's literally saying, look, I don't think it's a high risk that inflation is going to remain, but the risk has increased. We still think inflation is going to go down by like half next year. But yes, it has gotten riskier that inflation is a problem, especially because wage inflation could creep up, and rental inflation we already know is going to creep up, because rental inflation measured by the CPI is a total lagging indicator. It lags by like 6 months. We already know that, so that's already expected. But this is literally the perfect thing he could say. He's literally saying, we're going to watch the data, and if it's a problem, we're going to deal with it. And we think we can deal with it. He's not sounding hawkish. He's sounding realistic. And I'll tell you, folks, the market loves it.
We have had now for a decade and more, a 4-part financial stability framework that we use so we can hold ourselves to the same kind of framework and not just treat each event individually. And there are 4 key areas: asset valuations, debt owed by households and businesses, funding risk, and leverage among financial institutions. So I would say asset valuations, I'm going to go really superficially here, but asset valuations are somewhat elevated, I would say. Debt owed by businesses, and households. Households are in very strong financial shape. Businesses actually have a lot of debt, but their default rates are very, very low. But nonetheless, it's something we're watching. Funding risk is by and large low among financial institutions, but we do see money market funds as a vulnerability, and would applaud the SEC's action this week. Leverage among financial institutions is low in the sense that capital is high. So overall, financial stability, that's how I would make an overall characteristic, but we break it down into those pieces. In terms of the things that we're looking at, it's the things we've already talked about to some extent. It's the emergence of a new variant that could lead to significant economic. If there were to be a variant, for example, that were quite resistant to vaccines, it could have another significant effect on the economy. We don't see that. We don't have any basis for thinking that the new variant that we have is that one, but it's certainly one we're looking at. I would say, cyber risk, the risk of a successful cyber attack is, for me, always the most, one that we would be very difficult to deal with. I think we know how to deal with bad loans and things like that. I think more a cyber attack that were to take down a major financial institution or financial market utility would be a really significant financial stability risk that we haven't actually faced yet. So I could go on with a list of horribles, but I think that's a decent picture of where I would start.
How about the cryptocurrency issues? Anything that worries you there that's going on in there in terms of, it's obviously a lot's happening in that sector. Is that concern you at all?
I think the concerns there are not so much current financial stability concerns. I, of course, would support the views expressed in the President's Working Group report on stablecoins. Stablecoins can certainly be a useful, efficient, consumer-serving part of the financial system if they're properly regulated. And right now they aren't. And they have the potential to scale, particularly if they were to be associated with one of the very large tech networks that exist. And you could have a payment network that was immediately systemically important, close to immediately systemically important, that didn't have appropriate regulation and protections. The public relies on the government and the Fed in particular to make sure that the payment system is safe and reliable, as well as the dollar, and to provide a safe and reliable, trusted currency. So, but I do think those are longer term. In terms of the cryptocurrencies, that are really speculative assets, I don't see them as a financial stability concern at the moment. I do think they are risky. They're not backed by anything, and I think there's big consumer issues for consumers who may or may not understand what they're getting, and there's certainly developments in the markets that are worth following, which are really not in our jurisdiction. But things like the kind of leverage that's built into them and those sorts of things is certainly worth watching.
Let's go to Nancy Marshall-Genzer at Marketplace.
Chair Powell. Hi, Chair Powell. Thanks for the question. Going back to inflation, is the Fed behind the curve on getting inflation under control?
So I would say this. I actually think we are well positioned to deal with what's coming, with the range of plausible outcomes that can come. I do. And I think if you look at how we got here, I do think we've been adapting to the incoming data really all the way along, and noticing and calling out that both the effects and the persistence of inflation, of bottlenecks and labor shortages and things like that. So we've been calling out the fact that those were becoming longer and more persistent and larger. And now we're in a position where we're ending our taper within the next, by March, in 2 meetings, and we'll be in a position to raise interest rates as and when we think it's appropriate, and we will, to the extent that's appropriate. At the same time, we're going to be seeing a few more months of data. I don't actually think we're out of position now. I think this was an important move for us to make. I think that the data that we got toward the end of the fall was a really strong signal that inflation is more persistent and higher, and that the risk of it remaining higher for longer has grown. And I think we're reacting to that now, and we'll continue to adapt our policy. So I wouldn't look at it that we're behind the curve. I would look at it that we're actually in position now to take the steps that we'll need to take, in a thoughtful manner to address all of the issues, including that of too high inflation.
Let's go to Evan at Market News.
Hi, Chair Powell. Thank you. I was wondering if we should still be seeing the taper and interest rate hikes as separate. And secondly, in the last cycle, the Fed started shrinking the balance sheet when short-term interest rates were about 1 to 1.25% range. Do you think the FOMC might be able to potentially start running off assets before that this time?
Are they separate? So our interest rate, they are separate tools. So the asset purchases are a separate tool.
Someone says course members getting Christmas treats from Kevin. Yeah, that's because I may have been sending out some buy alerts. Which, if you want those, remember, you get lifetime access to the programs. Use that code XMIS link down below.
Stance. The extent to which they'll be separated in time is something we haven't really discussed at the committee yet. We will be discussing that, obviously, in coming meetings. I don't think that the last cycle, there was quite a long separation before interest rates. I don't think that's at all likely in this cycle. We're in a very, very different place with high inflation, strong growth, a really strong economy. That as I mentioned, the SEP medians are for 4% growth next year, 3.5% unemployment at the end of the year, and the headline inflation of 2.6% next year, core at 2.7. So this is a strong economy, one in which it's appropriate for interest rate hikes. So they're separate, I would say. Your second question was?
My second question was about runoff.
Runoff,
in the last cycle.
With the balance sheet, we did have a balance sheet discussion. It's our sort of a first discussion of balance sheet issues at our meeting this week. We'll have another at the next meeting and another at the meeting after that. I suspect these are interesting issues to discuss. Didn't make any decisions today. We looked back at what happened in the last cycle, and people thought that was interesting and informative. But to one degree or another, people noted that this is just a different situation, and those differences should inform the decisions we make about the balance sheet this time. So haven't made any decisions at all about when runoff would start, but we'll be continuing to, in relation to when either liftoff happens or the end of the taper. But those are exactly the decisions we'll be turning to in coming meetings.
Okay.
Thank you. We'll go to Scott Horsley at NPR.
Thanks, Mr. Chairman. I think you said a few minutes ago that the inflation that we got during the pandemic was not the inflation that you anticipated when you crafted the framework, and you described it as a collision of a lot of monetary and fiscal stimulus with these supply side hiccups. Does that mean the stimulus was mistaken, or is the inflation just a consequence of that we have to put up with?
It's the supply wall. It's the supply wall he talked about, the vertical.
Not expressing any judgment about the stimulus in that comment. What I'm saying is there's a sense among some that you wanted inflation. This is what you wanted. How do you like it? And the truth is, this is not the inflation what we were talking about in the framework was inflation that comes from a tight labor market, right? So we had 3.5% unemployment for a period, and we had inflation that was just barely getting to 2%. And I think in that setting, our thinking was we can afford to wait to raise rates until we see actual inflation rather than preemptive, because no one had seen what 3.5% unemployment would look like with high labor force participation, by the way. No one had seen what it would really look like for an extended period for decades. And we didn't know what the inflationary implications were. Turned out there was barely 2% inflation and no sense that it was gaining momentum and that kind of thing. So we incorporated that into our framework. This is something completely different. That's a situation where you had a very, very high level of employment and low inflation. This is literally the opposite, or it has been the opposite, where we have very high inflation, and we've had it since the labor market was in terrible shape. It had nothing. So far, this inflation has really nothing to do with tightness in the labor market. It does have to do with strong demand, and strong demand was supported by the Fed. It was supported by Congress. I'm not making any judgments on Congress. It's not my job, but I will just say we're coming out of what we certainly hope will be a once in a lifetime, certainly historic, the first really global modern pandemic, which looked at the beginning like it might cause a global depression. And, so we threw a lot of support at it. And what's coming out now is really strong growth, really strong demand, high incomes and all that kind of thing. People will judge in 25 years whether we overdid it or not. But, the reality is we are where we are. And, we think our policy is the right one for the situation that we're in.
Thank you. Let's go to Brian Chung.
Hi, Chairman Powell. Wanted to ask about the bond markets. When you see the 10-year at 146 basis points, do you have any sort of concerns about an environment by which you might be hiking interest rates into? Would you prefer the curve be a little bit steeper? What are you gleaning from the bond market actions over the last 6 weeks?
So I think the short end actions are easy to understand, which is, they're basically very policy sensitive rates at the short end. And it makes sense that's reacting to changes in expectations for policy. I think a lot of things go into the long rates. And the place I would start is just look at global sovereign yields around the world. Look at JGBs, look at bunds, and they're so much lower. You can get, a much higher yield on U.S. Treasuries by buying USTs rather than bunds, and you can hedge the currency risk back into yen, back into euros, and still be way ahead. So in a way, it's not surprising that there's a lot of demand for U.S. sovereigns in a world, in a risk-free world where they're yielding so much more than bunds or than JGBs. So that's a big part of it. I also think there may be some assessment in there of what the neutral rate is or what the terminal rate is. I don't know about that, but I would just say that we write down our own estimates of the terminal rate or the neutral rate of interest. Those are highly uncertain, and we'll make policy based on what we're seeing in the economy rather than based on what a model might say the neutral rate is. We all have the experience of the last cycle, where we all through that cycle were trying to estimate what the neutral rate was, and it turned out, I think we learned a lot from seeing what happens. We wound up cutting rates 3 times after raising them to 2.25% to 2.5%. So I'm not troubled by where the long bond is. I see that it's low. We're really focused on broader financial conditions. We're focused on maximum employment and price stability.
Thank you. For the last question, we'll go to Greg Robb.
Thank you very much. Chair Powell, I was wondering if wanted to give you the opportunity to talk about something I've heard that's been discussed, that, your pivot towards a tighter policy, hawkish policy stance had something to do with the timing of your re-nomination by the president. Thank you.
Sure. I'd be happy to talk about that. So as I mentioned, we got the ECI reading just before the November meeting. We got the labor market report 2 days after the meeting. And then 1 week after that, I think on the 12th of November, we got the CPI reading. It was really the CPI reading in concert with those two. And I just came to the view over that weekend that we needed to speed up the taper, and we started working on that. That's a full 10 days or so before the president made a decision on renominating me. So honestly, it had nothing to do with that at all. And I just thought, this is what we got to do. My colleagues were out talking about a faster taper, and that doesn't happen by accident. They were out talking about a faster taper before the president made his decision. So it's a decision that effectively was in more than in train, and to the point where people were talking about it publicly. So that's what happened, and it had absolutely nothing to do with it whatsoever. We're always going to just do what we think is the right thing, and I certainly will always just do what I think the right thing is for the economy and for the people that we serve.
Just a quick follow-up. I guess that some people are saying that it was the the stimulus in March that was sort of over. We didn't really need all that stimulus, and that there was talk even then that would be a mistake and it would lead to higher inflation, and perhaps that you didn't push back as much as you might have otherwise.
I didn't push back at all, and the reason I didn't, and there was lots of talk about that, but not from the Fed, because that is not our job. We are not the CBO, and we're not elected by anybody. So we take fiscal policy as it arrives at our front door, and we don't comment. We make our own assessments inside the Fed, but it's really not our role. And I think very important that we stay out of that business, no matter who's in the White House, who's in Congress. It's just not our job, and it's something we avoid pretty assiduously.
Thank you.
Thank you.
Thank you, Mr. Chair. Thank you, everyone.
Boom.
Chair Powell wrapping up.
Woo! Literally went as freaking expected. Yes, this is perfect. Did lots of buying before. I also did lots of buying after. Well, probably kind of during. And the market is loving this. I mean, Jerome Powell killed it. The market's loving what's happening. This is it, folks. We're done for the year, in my opinion. The negative catalysts are gone. I'm sure there'll be others that we're not seeing right now. But I mean, look at this, folks. This is insane. This is very, very good. I mean, let me just put it this way. I may have gone into margin a little bit. Look, the catalyst we had written down on November 29th. Okay, this is why you subscribe to the channel. On November 29th, we talked about this. On November 29th, we said, holy smokers, we got lots of negative catalysts coming for December, and it's going to suck. Lucid was going to go down, we said. NEO was going to go down, we said. They plummeted. Robinhood was going to go down a lot because of the lockup. Oh, yeah, that definitely happened. And you want to buy it at the bottom. We said the Congress, the debt ceiling, and the budget deficit would be a nothing burger. What happened? They were nothing burgers. We said a catalyst would be CPI and the FOMC. Yep. Literally the last week between these two reports has been the ugliest. We said that there would be year-end profit-taking and loss-taking, and that Omicron is probably a nothing burger. Kind of what we got. I mean, it's also kind of what J. Powell literally just said. I mean, I hate to say it, but I think we did pretty damn well. So I just did a ton of buying this morning, a lot of buying, multi-seven figures of buying of various different cryptos, of different stocks, both before and after and during, literally everything. If you want to see all of those, always remember you can take advantage of the alerts, all of the alerts that come out in the Stocks and Psychology of Money group, linked down below. All right, let's now do a summary, because everyone always comes for them summaries. All right. Give me a second. Where's my clapper? No, I don't need a clapper. Hold on. All right. Whew. The alerts are in the Stocks and Psychology of Money group, Kyle James. Thanks for asking. Man, that was exhausting. Okay. All right. You ready for a recap? All right, here we go. Should pull that up too. One sec. That's pretty good. We should put this up. For all the people who want to watch this tonight or who joined late, let's do a quick recap and then let's go look at sticks. Okay, who's ready? Okay, I keep saying that. Just freaking go already. All right. I got to one take it. That's the problem because we're live. All right. Hey everyone, me Kevin here. Here's a complete breakdown of everything that just happened at the Federal Reserve and why the market is reacting the way it is. Let's get right into it. First, interest rates were kept at zero along expectations. Nailed it. Doubled the pace of the taper from $15 billion to a $30 billion reduction in bond purchases. That means we are still printing $75 billion, but we are reducing as expected. This is good. The market likes when things happen along and in accordance with expectations. The market does not like uncertainty. Anytime there's uncertainty, stocks plummet. That's why we've had so many red days leading up to this meeting. Every time there's uncertainty over what J. Powell is going to say or do, the market falls. Same thing is true when you look at the beginning of, like right before the election, just as an example of 2020. Lots of uncertainty, stocks fall. Very normal. Now, the Federal Reserve has essentially guaranteed us a rate increase in 2022. This is important to know. And what we could do is we could look at a summary of economic projections. This is a little bit messy. I'm going to explain it. There's a lot of information here. The blue dots are from the Fed. Everything else is my garbage. What you need to pay attention to, we're going to highlight it with this little green highlighter is right here. Okay, this is what you got to pay attention to, this yellow highlighter. And that is a guaranteed rate increase, essentially, at least one rate increase. However, the median forecast is for a triple set of rate increases in 2022. That would bring us to just below 1% or an expectation of 0.9%. Keep in mind, there are only 8 meetings in 2022. Unless we double up a rate increase in 2022, 38% of the meetings in 2022 will contain a rate increase. We do not believe the first one will be January. Jerome Powell made it clear we will not raise rates until we finish tapering. We will not finish tapering until March. Jerome Powell was asked, hey, are we going to have a lag between when you finish tapering, aka March, and your next meeting, aka May? Jerome Powell answered this. So now I'm going to remove this little Kevin's guess thing here because I agree with what the market believes now, based on Jerome Powell's answer, that no, we do not need to have a lag between the last or when the taper finishes and raising rates, which basically means March. That's what he's saying, rates going up in March. The federal funds futures are already pricing in a 90% chance that rates will be up for the first time by April. But that means they're going to do it in March based on the market's expectation because that's when the meeting is. Okay, then we're expecting 1 to 2 rate increases in 2023 and 1 to 2 rate increases in 2024. I wrote down that there's only like a 5% chance we would actually see rate increases in January. Very unlikely that we'll see rate increases in January. Again, Jerome Powell made that pretty clear as well. Now, the Federal Reserve has also changed their summary of economic projections regarding the unemployment rate and inflation rate. This is very important. This is critical, okay? This chart is mission critical right here. The Federal Reserve realizes that inflation is worse. Jerome Powell said this numerous times, specifically because of Delta. Before Delta, we had 5 months of CPI inflecting down, and crypto fell during that time. Now you have CPI a lot higher because of those supply chain constraints. Basically, Jerome Powell saying we hit a wall with supply. We thought we would see inflation because of all the fiscal and monetary money printing, essentially, and the helicopter money we've been doing. But we're actually seeing it because of supply chain issues. You go to a vertical supply curve, which basically means, hey, we want car, and then instead of price going up diagonally, price is just going up straight. It's just a visual depiction, doesn't really matter. But anyway, Jerome Powell does believe, and the Fed does believe, together, that inflation will go down to 2.6% at the end of 2022, which is about half of where we are now. They have revised to the better their expectations on unemployment. They expect the unemployment rate will be 3.5% by the end of the year. They previously thought it would be 3.8%. They have also increased their expectations for GDP, which means they think the market is going to grow by 4% in 2022, which is more growth than they thought they would have had in 2022 when they first did this projection in September, or when they previously did this projection. We think we're going to grow at 4% despite the triple rate increases. The market has substantially priced in this interest rate news and this Federal Reserve news, and this is why, if you look at the S&P 500 and a substantial amount of stocks that have sold off heavily, you can see that we've had a substantial move to the upside here in not just the S&P 500, but many different tech stocks. The market is liking what they heard from J. Powell because they did not get rug pulled. This is why I put in multi-7 figures of money into the stock market over the last 3 days leading up to this meeting. Sent all of those alerts, of course, to everybody in the Stocks and Psychology of Money group. And we talked about this in our private live streams, which you can have access to as well if you use that coupon code XMIS before December 25th at 11:59 p.m. Now, part 2, I've also bought during the meeting, essentially right now, because there was always the chance that we did get a rug pull and then you'd want to have money. Now we don't have a rug pull. Now we actually don't have that many catalysts of negativity going forward. Now I'm going to talk a little bit more about what Jerome Powell said, but let me just quickly reiterate the negativity that we had on November 29th. November 29th, we thought Lucid and NEO were going to go down, went down. We thought the Robinhood lockups were going to be a disaster. And you can watch this. December catalyst to watch. Meet Kevin. Type it into YouTube. We thought Robinhood was going to plummet because of the lockups. It did. Just YOLO'd on the dip, by the way, this morning on that one. I got some call options on that one. Full transparency. We thought Congress with the budget deficit would be a non-issue. We thought the debt ceiling would be a non-issue. Both of those ended up being a non-issue. We thought the FOMC meeting and the CPI release would be the biggest negative catalyst. They were. Obviously, profit taking and loss taking towards the end of the year with hedge funds and a lot of selling by corporate executives because of taxes going up. We already know that. Now, some of the other things. So this eliminates a lot of the catalysts that we had. The only catalyst right now is Omicron, which most of us think is really a nothing burger, and that this could actually be the beginning of the end of the pandemic, right? Okay, next. Then Jerome Powell told us, look, inflation is well above our 2% target. It's going to continue well into next year. And there are things that could continue to increase inflation. Things that could continue to increase inflation are things like rents, because the stupid way they measure owner's equivalent rents lags rent increases by 6 months. So that is going to push inflation up in 2022. Wages could push inflation up in 2022. However, the Fed still expects inflation to halve by the end of 2022 as more of the transitory items come down, like transportation costs, food costs, and some of the other things that are affected by supply chain issues, like chips, cars, and so on. Now, why not stop all purchases of bonds right now? Why are you still printing $75 billion? Because they want to take a methodical approach and clearly signal to the market what they're doing. They don't want to rug pull the market, being very, very transparent and nice here. Now, Jerome Powell is basically telling us we're going to see liftoff in March, I wrote down. I kind of already explained that. Jerome Powell also says that we're probably not going to see a strong labor force participation recovery until the end of the pandemic. Omicron is a risk. However, listen to this line from Jay Powell, okay? Jay Powell literally said, quote, "People are learning to live with this." He's basically telling you, who cares? Like, no, obviously that's not what he's saying, but like that's what he's signaling. He's like, well, we don't think Omicron's that big of a deal. He kept referring to how bad Delta is and how Delta is surging right now, hitting the northern part of the country, the Northeast, and coming down the East Coast. And the wave of Delta is a big problem. But Omicron, he did not talk about that much. Now, he did talk about how this was big, okay? He says, yes, inflation is expected to be higher, but he says, look, we're being straight up here. We think that we are doing the right thing by raising rates 3 times and tapering the way we are right now because of the more persistent inflation that we're seeing. We think this is the proper reaction to get rates back down. He was asked, hey, but wait a minute, doesn't Federal Reserve monetary policy sometimes take 18 months? I'm glad Jerome Powell answered this because conventional wisdom, economics studying, when I studied economics for an economics degree, I was taught this as well. You have an 18-month lag. This was a very Milton Friedman argument. Jerome Powell said exactly those words. But Jerome Powell says because of the way he communicates now, or the way the Fed communicates now so clearly, he thinks the markets actually price in a lot of these moves by the Fed much sooner. Interest rate moves, taper moves, whatever, and that a lot of this gets priced in by the market much quicker. I want to be clear here. Jerome Powell did not sound bearish today. He sounded realistic. He gave us literally the best presentation he could, and the markets are cheering on that. Now, the S&P, a lot of tech stocks have done very well. We'll go back to the sticks, later on here, but he's being pretty crystal clear. He talked a little bit about cyber risk being a very real threat. He talked about seeing cryptocurrencies as risky, but he did not see them as like an exigent financial risk. He did mention that consumers seem to be at solid levels of leverage, like elevated levels, but not concerning levels. He did mention that businesses were at elevated levels of leverage as well, but no signs that businesses were defaulting. If anything, things looked, businesses had a very, very low default rate. That was his wording. Very, very low default at businesses. Relatively low household debt, despite the fact that margin is at all-time highs. Household debt relatively low, probably because of real estate equity and asset equities and asset equity. So equity in other assets. He did say that valuations were relatively high, but that overall he does not believe we are behind the curve. And if anything, they're moving appropriately in response to the concerns the market has right now. Again, the market has been cheering this. Volatility index fell immediately below 20. I would expect to see fluctuations over the next few days, but honestly, I hope that this is the beginning of the Santa Claus rally, and I hope you will follow me in the moves. Well, I mean, not financial advice. Don't copy my moves, but I hope you appreciate the moves that I post in the Stocks and Psychology of Money group. Link down below, and you can use that Christmas coupon code Xmas to get the best pricing on it. The pricing does go up over time, and it'll go up next on the evening of Christmas. Well, thank you so much for watching this video. Appreciate y'all, and we'll see you in the next one. Cool. That video is done. Now what we're going to do is we're going to jump on over to the closing live stream. So if you want to hang out, you can. Fed talks over now. We're going to look at the sticks because we're only 15 minutes away. It doesn't make sense for me to start a new live. So what Jerome Powell just said is going to be our next video. So what I'm going to do right now is I'm going to look to see what's moving in the market, where I think there are still leftover deals because some things have moved quickly. I do think there are going to be fluctuations. So don't buy crap right now and expect to be up the very next minute. You are going to see... you're going to see fluctuations as the market tries to digest all of this, but I think we're pretty early on this, especially if you've been watching the whole time here. So S&P having a tiny little bit of a cool down here as we go into the close. I just quickly have to hit export on the video that we just filmed, and okay, we're good. Cool. So S&P chillaxing a little bit. Let's just go ahead and finish our stream out here. Let's see what's going on. You do have Roku sitting at 102, relaxing a little bit as we go into the close here. A little bit of selling into the close. Now keep this in mind, okay, folks? This could be very, very interesting, and I think this is quite possibly what's happening. Oh, wait a minute. This is actually an opportunity. Oh my gosh. I didn't even think about this until, well, like I just started thinking about it. Okay, hold on. I think you're going to like this one. This is a thesis, but I think you're going to like this thesis. Okay, so you know how at the end of the day, institutional investors have to sell because people called up their hedge fund managers and they're like, man, this market sucks. I'm going to buy gold. And they withdraw money from the funds, right? Guess when those institutions make those sale transactions? Well, most of the time, right at the end of the day. Like literally right now. I would not be shocked if what you see at the end of the day here is actually a SPY sell-off. You're going to get this SPY sell-off because people already put in their sell orders that are just now getting filled with their institutions. People taking money out of their retirement accounts, this, that, whatever. Who cares, right? People are... So you got institutional selling pressure. And really what we're potentially creating here at the end of the day is another opportunity to buy the dip, which is really cool. Oh, crap. Hold on. Stupid. There we go. Sorry, my little microphone. There we go. Anyway, so you're getting potentially another opportunity to buy the dip towards the end of the day here because the weenie babies who wanted to sell this morning are just getting executed towards the end of the day. So this right here, this sell-off at the end, I think is actually a representation of more fear and fear porn that we had this morning, and not actually people in mass right now trying to get out of the market. I don't know, but I'm making bets on a continuation of the end of the year rally. We just don't have that many negative catalysts left. Like what's going to happen? Like war with China? Or war with the Ukraine? Yes, like literally, those things could happen. Are they likely to happen? Not really. Are we expecting more Evergrande drama? Not much that's going to move the market. Do we think China's going to potentially keep forcing the delisting of stocks? Oh yeah, definitely possible. Do we think, are we going to get another CPI report anytime in the next 3 weeks? No. Is the Fed going to speak in the next 3 weeks? I mean, maybe in interviews and stuff, but probably nothing major. Is Congress going to do anything in the next 3 weeks? No, because they're off. How are they going to do anything? They're not there. So like the amount of potential catalysts we have that are negative, my belief is, are extremely low going into the end of this year. I think people literally got fed exactly what they wanted to hear here. Now, we could all be little pawns, and we could just be getting screwed by the Fed here, who's telling us what we want to hear. We're going to throw our money in, and then we're going to go bankrupt when the real rug pull happens next year, when they raise rates. But honestly, the Fed just told us we're going to raise rates. You don't think the market's starting to price that in? Newsflash, it is. So the market knows what happened at the end of 2018. The market does not, like, investors don't want to be part of that. And so I think that's why we've had this like PayPal sell-off, this sell-off in, some of the other stocks, Square, Wayfair, other ones that are at all-time lows. Watch my video that I made earlier about the PEG ratios for 10 stocks, but look at them. Snap, EXPI, SoFi, Roku, Wayfair, Corsair, PayPal, Hood, Square, Disney, Trade Desk, other ones that were getting hurt, Airbnb, Matterport, NVIDIA, Net, Lemonade, Palantir, Shift. These are pain ones. Okay. All right, we're going to look at the sticks again here. So, oh, look at that. The SPY's already ticking up a little bit. Seriously, I think any dip you're going to get at the end of the day here is a blessing. And we're going to look at individual stocks. Just a second. Okay. Let's give CNBC like 30 seconds to talk.
Still be doing emergency stimulus. In fact, if you look at areas like the housing market, it's been counterproductive. Sticker shock on homes actually slowing the number of transactions. So nobody wants to see more of this. It's good that it's coming to an end. I would point out that on a net basis, we are still adding liquidity to the system. We're just doing so more slowly than we were. So to me, that's still outrageous, but I understand this has to take place in a progression. Big picture, it's a very weird bounce today. It's respectable, but it seems to be very defensive. You look at Staples ripping to all-time highs, McDonald's, Pepsi, Coke. You look at Costco, which I would consider to be defensive. XLU, which is the utilities, making a 52-week high. Healthcare making an all-time high, also defensive. So that's not a bad thing. I'm just pointing it out. It doesn't look like people are like getting all bulled up on the economy. So
I am.
Obviously is adding a lot of strength here, up another 2%, getting back to that record high. So that's where we are. It's a good thing. It's not a bad thing. But overall, I think most of what we're seeing here is not a renewed exuberance. I think it's just people saying, okay, the comet missed Earth again. Great news.
No problem. I'll place my bets against you because I think it is a renewed exuberance. I guess I wouldn't say exuberance. I think fear is going away. Okay, I posted the video you watched me record. Okay. Oh, look at that. Tesla, let's go. Oh, it's happening. Oh, Corsair's up 4%, and I got calls on that one too, puppy. Let's go. Oh, yes. Ooh, some of the small caps are moving. Ooh, NVIDIA over 300. Let's go. Just bought a bunch of that too. Oh my gosh, yes. HUD 8's moving. EXPI, perfect. Just bought that this morning. Good run. Cloudflare, still a long way to go on Cloudflare. But this is good. Higher valuation on Cloudflare, so be careful on that one. Etsy, I gotta frack. I forgot to buy Etsy. I bought like literally everything I wanted to this morning except for Etsy. Well, that's okay. I bought a ton of stuff. I kind of burned all my money, but I did want to add to Etsy and I didn't buy that one. Roku recovering. Let's go. That's awesome. Very good. Let's see here. Okay. Trying to get... Let's see here. Okay. Then we've got, let's see what else we have. Okay, recovery stocks. Wait a sec. Are they recovering now? Let's see here. If recovery stocks are recovering. Yeah, it does look that way a little bit. Look at that recovery you got on the recovery stocks. You know why they were falling? It was because you had, what's it called? Jerome talking about the Delta surge. The Delta surge is what freaked these guys out. Look at that, 1790 on Carnival. It's not bad. I mean, I'm not touching these recovery things because I think the case porn we're going to get is going to be extreme. But look, Disney's back up. Visa's back up. Matterport went positive. Holy smokes, we had so much red this morning. It was so juicy. Let's see what else here. Lemonade. I can't believe Lemonade's almost up 7%. But then again, it sold off so much. NVIDIA's on a run now. Oh, yeah, let's go. EXPI, 6%. Awesome. Corsair, 5. Etsy's up 5. I'm trying to look. Look, Affirm at 110, still not a bad deal. You've got Enphase at 204. Not a bad deal, y'all. Not a bad deal at all. SoFi at 1511. It's not bad. Oh, Robinhood, let's go. It's going back to 20. Yes. Perfect. Oh, I bought 420 short-term options on this sucker this morning. Let's go. Oh, that's good. It's literally, I'm just going to knock on wood that it stays this way. We don't end up getting rug pulled this morning or later today, because I'm going to get destroyed if we get rug pulled later. But this is literally unfolding the way we expected it would unfold. Max pain right before the potential rug pull, which we didn't expect, but that's what the market was pricing in, was some potential, shocker, which is not what JPOW promised us to do. JPOW promised us to be very transparent, and I know a lot of you don't trust JPOW, but and I don't blame you, because I lost a little bit of respect when he started conveniently right around the time he his job is up for renewal. He starts kind of sucking up to Biden a little bit more. I didn't love that, but otherwise I do trust the guy. Okay, I'm just gonna stop talking about that. So let's see. Okay, Kobe says, I hate watching this guy celebrate. Dude, Kobe, I didn't know you were still around, man. Oh, sorry, that's probably too soon. Sorry. Oh, man. Blessings to Kobe. That was so terrible. That only happened like 20 minutes away from where I live. It's kind of sad. Really sad. Scary. Anyway, okay, where was I? Okay, so Toast recovering a little bit. I'm falling a little bit into the close. SPY still rallying into the close. Look at that volume. Okay, so that little bit of sell there turned into a buy signal for a lot of folks. Okay. Looking for more. I also bought a bunch of crypto this morning. Just actually within the last few hours here, a couple hours. Voyager Digital up. I wouldn't be if we get a good bounce here off, and we are. This is risky, but Hut, folks, Hut might be a place to go. Very risky. Hold on. Let me look here before I do anything. Okay, I'm gonna look at Hut. I'm gonna go 93s at in the money. Can I get something in the money? That puts me at $9. What are we at now? $8.60. That puts me at 9.25 break even. Why am I going out that far then? Screw going out that far. Let's go to so risky, so dumb. Stop doing it. Too risky. Oh, we only have a minute left to go. Oh God. Okay, January spreads super tight for Jan, and we're gonna go for 750s, fives put me at 360. That puts me right at the money where we are right now. That I feel like is almost like a free op. What do I want to do? Oh my god. Can I place the order? No, can't place my order. Dang it. I'm not going to get it through. Why? Screw you, Chase. Oh, I got a little bit in. Okay. It's not as much as I wanted. I only got a little bit in. Yeah, there's no way I'm going to get more. Come on, Chase. You screwed me. Yeah. We're going to close before if I tried putting in more, there's no way. There's no way. Call. Come on, Chase. You suck balls. Am I gonna make it? No, there's no way. That didn't go through. Dang it!
Jeez. Not anyone cares about the MLS, but at least it's the right score. 500 up 1.7% at the close. The Dow up 1.1% and the Nasdaq up just over 2%.
And welcome to Closing Bell. That other sound you hear is Wilf's phone ringing from all the MLS fans watching today. I'm Kayla Tausche in for Sarah Eisen along with Wilfred Frost. Eli Lilly, the biggest winner in the S&P 500 today after announcing very strong guidance. Coming up, we'll discuss that outlook in an interview with the company's CEO. You will not want to miss that. Plus,
dang, that was exhausting. Oh, dang it. All right. Oh, well. I think we did good. Okay, so what happened? The Dow went up 1.08%. The S&P went up 1.63%. The NASDAQ went up 2.15%. The Russell went up 1.65%. The market went ape. Let's go. Honestly, I think we're going to have green futures tomorrow. It's time to either shave my head or dye my hair green again because this is good. I don't want to be too euphoric, though. I could get blindsided. I could get black swanned. Yeah. Lot of things could happen. But whatever. Tomorrow is another day. Let's take a look at some of the madness that happened today. Roblox still down 9%, but Roku recovering about 5% intraday, still down about 8% on the day. But nice recovery intraday. Neo is sitting closed at just at 30.75, was below 30 for a period of time there. Xpeng down 3%. You have Poshmark, Cheesecake, some of the recoveries going down. Peloton still down. Carnival Cruise Lines at a low. Shift Technologies is at a low. Small caps recoveries are a no touch for me right now. Unless we get some more of a kind of a confirmation that it's time for a small cap rotation, which I don't think we're anywhere close to. Technology stocks that are loved, like Matterport, did end up rotating back up. Matterport was down substantially this morning. It was under 21 for a period of time, ended up 22.33. You've got Coinbase rotating up. Obviously, the cryptos are moving up. They fell to our line as expected and started moving up. You've got AMC ending up positive. It was in the negative earlier today. We have Enphase up 0.85%, sitting at 205 in the after hours. Still a really good deal for a high margin solar play. That's not a solar panel play. Really important. Really good high quality products here. Next closest competitor, in my opinion, is Tesla and SolarEdge for Enphase. And most of Tesla's batteries are going for the cars. So as long as they keep directing Tesla batteries to the cars, they're going to have less batteries for power walls at Tesla, which means higher prices for the power wall, which means more competitiveness and higher margins for Enphase. Google was down about 1.5%. Now it's up 1.5% at the end of the day here. Bitcoin is making its way back to 50,000. I wouldn't be surprised if we break that relatively soon. Tesla almost back to 1,000. We're down to 930 this morning. I was hoping to break under 9. We did not. I did do my shopping, though, on Tesla. I did do my shopping on Robinhood. Let's go. Oh, yes. Robinhood up almost a full 2%. It was way down this morning. It was in the 17 range. Right at about 18 is where I bought a ton of options on this thing, 420 options on it. It's up 2% roughly right now, including the after hours moves. We've got ChargePoint heading back to $20 in the after hours. PayPal 2% to the upside on the day. Looking for a rotation maybe on some of those payment processors. ARK ends the day up 2%. I also made a bet on Kathy at the end of the day. So Kathy's ARK is pretty dang well near all-time lows. We're at, what are we at? 95.55 now. I shouldn't say all-time lows, but very, how long ago? The last time we were at 90 was like October, November of last year. Thank you. So grabbed some ops on the ARK K. We've got, what else is selling down? Adobe was down like 6% this morning. Wow, what a U-turn on Adobe. That's incredible. Amazon up 2.5%. Still going to be a big advertising play next year. Apple almost back to 180. Wow. Kathy would do the same for me. That's nice of you to say. Okay, what else? SunPower, solar panels, after they got that downward revision yesterday, had a big sell-off yesterday, move up. Whoa! Trade Desk had a U-turn. Holy moly. This thing, I sent out an alert this morning in the Stocks and Psychology of Money group that this thing was sitting at $85. And a $6 swing from its low. That's crazy. Good. Redfin trying to get back to 40. Cardano started running a little bit, came up from the 122, sitting at about 131 right now. I think it's an opportunity to play crypto. Cardano, honestly, should be closer to $2. It is way oversold. SoFi Tech, 1516, kind of relatively close to that 1470. It did a ton of loading up under the line. Affirm 110. Decent. You got to be careful, though. Affirm, money-losing company, no profitability path yet. So you want to limit how much you have for these guys, but still an amazing company. EXBI, Corsair, Cloudflare made moves on these this week. Lemonade showing its first sign of a U-turn here. Finally at 43.66, first U-turn. Keep in mind, this, folks, I kid you not, $40 is an all-time low for Lemonade. You do have to keep in mind, though, that Lemonade does not have a path. Hold on, let me verify that. I don't believe they have a path to profitability, but now I'm going to double check. Bloomberger. Oh, and I think we have a couple earnings happening today. Let's see. I don't know if we actually do. Okay, so we have Lennar. Nah, I don't care enough. Yeah, no path to profitability on Lemonade. So limit how many stocks you have with no path to profitability. Otherwise, your portfolio could be in a world of pain. A whole lot of pain. Okay. And let's go up here. There we go. Voyager Digital, U-turning from 12. It usually does. It U-turns from 12, goes to like 17, 18. Certainly 16 should be in the forecast. DWAC is insane, but there's a lot of momentum in that one. NVIDIA right back over 300. Beautiful test. Beautiful test of that 300 to see that great rebound back over. Solana, nice move back up. It feels like crypto's taking a little bit of a kind of market close pause here, but this could foreshadow the beginning of a nice, decent move to the upside in crypto. We'll see. But this morning in the live stream, we did talk about Bitcoin heading back for our support line, which is exactly what it did. We saw this fall directly to it. Sat at it. Yeah, hold on. Wait a sec. I think the chart's bugged. There we go. Yeah. Okay, there we go. So this, Weeble, what are you doing? Okay, I'm going to go to 5 minute because Weeble's sucking right now. There we go. So we did our market open live stream right around here. We suggested that there was a good chance we were going to go back down to support. We did. We broke the blue, sat at the red, came back, and as soon as J-Pow started speaking, look at this. Leading up to J-Pow, the dip buying, very smart right here. This dip buying, very, very smart as soon as we broke through that. And so far, it's kind of been rallying here. So very, very cool. Hoping to get back over 50K here soon. Very exciting. Very, 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 very exciting. Now, it would make sense for the markets to be a little bit tentative on this because my expectation is it's going to take a while for the indices to get injections of funds again. It's going to take a while for people to digest this, people to report on this, people to talk about, okay, what did J-Pow just do? What did he not do? It's going to take a while to get all of that. So I'm hoping, and this is a hope. I don't have a crystal ball. We did very well with the J-Pow predictions, but that doesn't mean I have a crystal ball. I'm hoping this is the beginning of a Santa Claus rally. No guarantees, but I would love everybody to have a very green Christmas. And quite frankly, even right now, prices are still very good. There are a lot of things that have very good prices that have come off very nicely from all-time highs. And I'm not offended by a lot of the prices that we have, especially some of the companies that have just gotten obliterated. Talk about Square, talk about PayPal, or some of the other ones. Watch my video. I just posted a video about, what was it? Oh, what did I call it? Here. 11 stocks getting wrecked. May explode in 2022. Watch that one. That's a good one. I need to buy a crystal ball. Yeah, so that way I can say I have one. Exactly. Drew here says he 2x S&P's performance today. Would have had no clue how to do that today without the course. Thanks, Drew, for saying that. I appreciate that. We had fun in the course this morning. That was fun. This was a good day. Good day in the course. If you're not in it yet, join it. You get lifetime access. Price goes up over time. You're always guaranteed to get the best price the sooner you buy in because the price goes up over time. Robinhood, I'm watching this one, folks. This thing, I mean, this is so oversold. It's insane. But we're sitting at 1962 right now. I think we're easily going over 20. And quite frankly, we should be above 30 on this. We should be above IPO pricing on this. And if we get a nice run back over 30, I'm going to have some juice on those tendies. But we'll see. Don't get too overconfident. There's always a chance Black Swan comes out of nowhere and smacks us upside the head, in which case all this euphoria was just for entertainment purposes only. Tesla almost back to 1,000. I think just my thoughts. I think tomorrow is going to be great. I'm hopeful, and we'll see. Did I spend millions today? Yes. Course member live stream is always good. Thank you for saying that. I used to pick my stocks with a magic 8-ball before Kevin. Oh. 1050s. Nice. Your military discount. I mean, just send an email to kevin@meetkevin.com. MA. Yeah, let's see here. Before it's all her, China is the only one that could try to. Yeah, I agree with that. I think we're out of U.S. catalysts. I think you're really left to global catalysts. I'm expecting futures to be nicely green. No guarantees, just an expectation. Could be wrong. We'll see. And so I bought a lot. Now I'm going to go have a coffee. Thanks for being here. It was a fun 2 hours and 16 minutes. Y'all rock. Thanks for saying that.